159 yen to the dollar. That's where Japan's currency landed this Monday morning. And if you're not paying attention to this number, you're missing one of the biggest warning signs in global finance right now. Here's what happened over the weekend that nobody saw coming. The United States and Iran sat down for high-stakes negotiations, and they walked away with nothing. No deal. No progress. And the moment markets opened in Tokyo, oil prices surged and the yen started falling like a stone. Now, why should you care about this? Because what happens to the yen affects everything from the price of your electronics to the profitability of some of the world's biggest companies. Toyota, Sony, Nintendo, they're all watching this number. In the next few minutes, I'm going to explain 3 things. First, exactly why failed talks between Washington and Tehran sent shockwaves through Tokyo's currency market. Second, what this means for Japanese businesses and the 40 million households now paying more for everything they import. And third, whether the Bank of Japan might finally step in to stop the bleeding. Let me walk you through exactly what happened when trading opened in Tokyo on Monday, January 13th. The yen fell into the late 159 range against the US dollar. That means it now takes almost 160 yen to buy a single American dollar. To put that in perspective, just a few years ago, you could get a dollar for around 110 yen. The trigger was weekend diplomatic talks between the United States and Iran that ended without any agreement. When those negotiations collapsed, oil futures immediately jumped higher on fears of continued instability in the Middle East. And here's the chain reaction that matters for Japan. Higher oil prices mean traders expect Japan will need to spend more dollars to import energy. Japan imports virtually all of its crude oil, about 97%. So when oil gets more expensive, Japan needs more dollars to pay for it. That creates selling pressure on the yen. Currency traders in Tokyo wasted no time. As soon as markets opened Monday morning, the selling began. The yen, which was already weak heading into the weekend, dropped further into territory that's making policymakers in Tokyo very nervous. Here's something most Western analysts overlook. Japan is one of the most energy-vulnerable major economies on the planet. The country imports 97% of its crude oil, and roughly 90% of that comes from the Middle East. So when there's any hint of instability in that region, Japan feels it immediately. This isn't just about gasoline prices. Oil is the lifeblood of Japanese manufacturing. It powers the factories that make cars, electronics, machinery, and chemicals. It heats homes during winter. It generates electricity. When oil prices rise, production costs go up across every sector of the Japanese economy. The failed US-Iran talks matter because they signal continued uncertainty. Iran is a major oil producer, and any potential conflict or prolonged tensions could disrupt supply from the entire Persian Gulf region. Markets price and risk immediately. And for Japan, that risk translates directly into a weaker currency. There's also a psychological factor at play. Investors view the yen as a safe haven currency during certain types of crises, but geopolitical tensions that specifically threaten energy supplies flip that equation. Suddenly, Japan looks vulnerable, and money flows elsewhere. Let's look at the numbers that tell the real story. The yen has lost approximately 31% of its value against the dollar compared to its stronger levels in 2021. That's not a gradual decline. That's a currency in serious trouble. When crude oil prices jumped about 4% following the failed Iran negotiations, it added immediate pressure to an already stressed situation. Japan's monthly import bill for energy has been running at record highs. Every time oil rises by $10 a barrel, Japan's annual import costs increase by roughly 2 trillion yen. That's about $12.5 billion. Now here's what the mainstream headlines aren't telling you. This isn't just about one weekend of failed diplomacy. The yen has been weakening for months because of a fundamental gap between Japanese and American interest rates. The U.S. Federal Reserve has kept rates elevated to fight inflation, while the Bank of Japan has maintained ultra-low rates to support economic growth. That interest rate differential makes dollar investments more attractive than yen investments. Money flows to where it earns more. The Iran situation didn't cause the yen's weakness. It accelerated an existing trend and pushed the currency past a psychologically important level. The weak yen creates winners and losers across the Japanese economy, and the division is stark. On the winning side, you have Japan's giant exporters. Companies like Toyota, Honda, and Sony earn revenues in dollars and euros when they sell overseas. When they convert those foreign earnings back to yen, a weaker currency means bigger profits. Toyota alone has said that every 1 yen move against the dollar affects its annual operating profit by roughly 40 billion yen. So exporters are quietly celebrating. But here's the other side. Japanese companies that rely on imports are getting crushed. Food processors, energy companies, retailers who sell foreign goods, they're all paying dramatically more for everything they buy. And those costs get passed on to consumers. Inflation in Japan, which was near zero for decades, has been running above 2%. For Japanese households, this means higher prices at supermarkets, higher electricity bills, higher costs for everything from bread to gasoline. The average Japanese family is feeling the squeeze. Real wages, adjusted for inflation, have been falling. People have less purchasing power. Consumer spending, which drives about 60% of Japan's economy, is under pressure. The weak yen isn't just a number on trading screens. It's hitting kitchen tables across the country. Now here's where it gets interesting. And this is something most coverage completely ignores. Last year, the Bank of Japan spent a record 9.8 trillion yen, roughly $62 billion, intervening in currency markets to prop up the yen. They sold dollars and bought yen to slow the currency's decline. And you know what happened? It worked for about 2 weeks. Then the yen resumed falling. This is the dirty secret of currency intervention. When fundamental forces are pushing a currency in one direction, central bank intervention can only slow the move, not reverse it. The Bank of Japan learned this lesson the expensive way. Japan's foreign currency reserves, while still substantial at over $1 trillion, are finite. Every intervention uses up ammunition, and traders know this. Some analysts suggest the Bank of Japan may be hesitant to intervene again at current levels, having seen how quickly the effect wore off last time. The market knows intervention is coming at some point. The question is where. Many currency strategists believe the 160 level is a red line. If the yen breaks through 160 against the dollar and stays there, pressure for government action will become intense. We may be just a few trading sessions away from finding out. How are markets actually responding to this latest yen drop? According to reports, currency traders in Tokyo are intensely focused on whether the yen will breach the 160 level against the dollar. That number has become a psychological trigger point. Some market participants expect Japanese officials to at least begin verbal intervention, making statements designed to slow the yen's fall without actually spending reserves. Finance ministry officials have used phrases like closely watching currency moves with a sense of urgency in the past. Traders parse every word for signals. The Tokyo foreign exchange market saw increased volatility on Monday, with wider than normal spreads between buying and selling prices. That's a sign of uncertainty. When traders aren't sure which way things are heading, they demand bigger margins to take positions. Some analysts quoted in financial coverage suggest the yen could stabilize if oil prices retreat or if there's any positive news from U.S.-Iran diplomatic channels. Others warn that without a change in interest rate differentials between Japan and America, the yen's structural weakness will persist regardless of short-term headlines. The consensus view seems to be that we're entering a period of heightened currency risk for anyone with exposure to Japan. So what should you be watching in the coming days and weeks? First, mark January 24th on your calendar. That's when the Bank of Japan holds its next monetary policy meeting. Any hint of a shift in interest rate policy could dramatically move the yen. Markets are desperate for signals that the BOJ might finally begin raising rates, which would support the currency. Second, keep an eye on U.S.-Iran relations. Any resumption of talks, or conversely, any escalation in tensions, will immediately affect oil prices and ripple through to the yen. The diplomatic situation remains fluid and unpredictable. Third, watch the 160 level. If the yen breaks through and stays above 160 for more than a few days, the probability of Japanese government intervention increases significantly. That could create sharp, sudden moves in either direction. Finally, pay attention to Japanese inflation data. If prices keep rising, political pressure on the Bank of Japan to act will intensify. The Japanese public is increasingly frustrated with higher living costs, and that frustration has political consequences. The yen story isn't going away. If anything, It's becoming more important to understand for anyone doing business with Japan or investing in Japanese assets. Let me leave you with one actionable insight. The yen at 159 represents both danger and opportunity, depending on your position. If you're invested in Japanese export companies, the weak yen is actually boosting your returns when measured in yen terms. But if you're a dollar-based investor holding Japanese stocks or bonds, currency losses are eating into your gains. Hedging your currency exposure has never been more important. For businesses trading with Japan, now is the time to review your currency risk management. Lock in rates where you can. Build flexibility into contracts. The volatility we're seeing isn't going away soon. But here's the bigger picture that gets lost in the daily headlines. Japan remains the world's fourth largest economy with globally dominant companies in autos, electronics, machinery, and materials. The weak yen doesn't change those fundamentals. It changes the price at which you can access them. For patient investors, periods of yen weakness have historically created buying opportunities in quality Japanese assets. The currency won't stay at 159 forever. Nothing does. The question is whether you're positioned to benefit when the cycle turns. Thanks for watching. If this helped you understand what's happening with Japan's currency, hit subscribe. We break down Japanese business and economic news every week.